First argument you hear is there's not enough gold to support finance and commerce. It's like maybe there was once upon a time, but commerce has grown so much, the dollar value of transactions have grown so much, gold hasn't kept up. There's not enough gold in the world to support the world economy, so not enough gold. Second thing is, even if you had a gold standard, the gold supply doesn't grow fast enough. The new gold coming out of the ground comes out at a slower percentage tempo than world growth, and so you have a natural deflationary bias, and that's not suitable because we don't like deflation. So if you take the 24 trillion of money supply and you want to back it with 40% gold, you need $9.6 trillion worth of gold to support that money supply. If we don't, it isn't. And the problem with confidence, it's a very powerful thing, but it's psychological. It can be lost very easily. And once it's lost, it's impossible to regain. And so when you're thinking about money or how you want to allocate your portfolio or your preferred form of money, ask yourself this question: regardless of how it is viewed today, how comfortable am I that in the future people will still have confidence in this as money? That's the most important question you can ask. Economists, central bankers, etc., they'll tell you, well, gold can't be money. You cannot have a monetary system based on gold. We used to, everyone recognizes that. But there's a whole long list of reasons why gold cannot be money. And they'll throw these at you, and every time the subject comes up, you're at a cocktail party or whatever, and if you say, I like gold, or I have gold, or some of my wealth is in gold, they'll say, well, don't you know the following? The first argument you hear is there's not enough gold to support finance and commerce. It's like maybe there was once upon a time, but commerce has grown so much, the dollar value of transactions have grown so much, gold hasn't kept up. There's not enough gold in the world to support the world economy, so not enough gold. Second thing is, even if you had a gold standard, the gold supply doesn't grow fast enough. The new gold coming out of the ground comes out at a slower percentage tempo than world growth, and so you have a natural deflationary bias, and that's not suitable because we don't like deflation. Gold has no yield. That's Warren Buffett's favorite. Warren Buffett, everyone thinks he's a great stock picker. He's actually a genius at tax-deferred compounding. If you do that math, you'll understand why he's worth probably $70 billion, but Buffett doesn't like anything with no yield. Paul Krugman's favorite, gold caused the Great Depression. Gold caused financial panics. We can't have that. We have to have an age without depressions and panics, so we can't have gold. And then the old favorite, gold has no intrinsic value. It's my friend Joe Weisenthal in Bloomberg says, you know, it's a shiny rock, and I go, Joe, it's a metal, not a rock. But he says it has no intrinsic value. And then the other one, John Maynard Keynes called it a barbarous relic. That's usually the first one you hear. Gold is a barbarous relic. Okay. So if you take the 24 trillion of money supply and you want to back it with 40% gold, you need $9.6 trillion worth of gold to support that money supply. So I said there's 33,000 tons. I'm using a price of $1,300 an ounce. It fluctuates, obviously, but that's a good estimate. Comes out to 1.5 trillion. Aha. Not enough, right? You need 9.6 trillion, you only have 1.5 trillion. Okay, but what if you change the price? In other words, if you raise the price to $8,265 an ounce, now the same 33,000 tons comes to 9.6 trillion, which is just right to support commerce. In other words, there's always enough gold. When someone says there's not enough gold, just look at them and say there's always enough gold. It's just a question of price. You have to get the price right. And this is, when I talk about $10,000 gold, that's my intermediate price target. It's not a number I made up. I don't pull it out of the air. I'm not trying to attract attention. It's actually the implied non-deflationary price. These are up-to-date figures, but this money supply keeps growing. That 24 trillion keeps growing. So my estimate is, by the time you get around to a gold standard, which may happen, it'll be $10,000 now. Every one of these things is untrue. Every one of them, except the yield thing, which I'll come to, but they're all untrue. Let me show you why. So first of all, there's not enough gold to support finance and commerce. Well, what's the money supply in the world? If you take M1 for the US, China, the Eurozone, and Japan, so that's basically 75% of the global economy. So these are really the currencies and the economies that count. It's $24 trillion. Now, and how much gold is there? Now, I'm talking about official gold owned by central banks and finance ministries. The answer is 33,000 metric tons. How much gold do you need to back the currency? How much gold do you need in a gold standard? Well, that's a subjective judgment, but I'm using 40%. The Austrian economists will say, no, it's got to be 100%. You know, you can't have any leverage. Maybe. Historically, Very successful gold standards have been run with 20%. The Bank of England in the 19th century, the Federal Reserve in the United States in most of the 20th century had 20% backing. So 40% is actually quite high historically. So the point being, the limit on mining output is irrelevant. It's irrelevant because you can always buy private gold with public money and increase your gold supply and support any level of economic activity you want. So this one doesn't hold up. Gold has no yield. Well, this one's true, but it's not supposed to have a yield. Gold is money. So gold has no yield, but a $100 bill has no yield. Reach in your wallet, pull out a dollar bill, Canadian, US, whatever, and look at it. Does it have a yield? No. It's a perpetual non-interest-bearing liability of a central bank. So it's money, though. It is a form of money. It doesn't have a yield. Money doesn't have a yield. People go, oh, well, I get a yield on my money. I put it in the bank. When you put it in the bank, it's not money anymore. It's a deposit. It's an unsecured liability of an occasionally insolvent bank. People go, I have money in the stock market. No, you don't. You have stocks. I have money in real estate. No, you don't. You have real estate. I have money in bonds. No, you don't. You have bonds. In other words, if you want to convert real estate bonds or stocks into money, you got to sell it. And guess what? When you go to do that, probably everyone else in the world is doing it at the same time, and your money's disappearing, so-called money, before your eyes. And so, short answer is there's always enough gold, just a question of price, and you can expect in a gold standard the price will be $10,000 an ounce. Gold supply doesn't grow fast enough. Well, annual mining output increases the existing stock of gold about 1.6% a year. World GDP grows about 2.9% a year. Aha! Is it true? The gold supply doesn't grow fast enough to keep up with the economic growth. The answer is no. Again, this is nonsense. And the reason is that in addition to the 33,000 official tons, which I just talked about, there's about 150,000 tons of private gold. And if a central bank needs more gold to support the money supply, all they have to do is print money and buy it. In other words, you could set your gold hoard at any level you want just by printing money. And by the way, this is exactly how the Fed increases money supply. What they do is they print money and buy bonds. It's called an open market operation. Well, there's no reason you can't print money and buy gold to get gold, and then with a 40% ratio for every dollar's worth of gold, you could have $2.50 of money supply. So you can't have discretionary monetary policy and a gold standard at the same time. In fact, the United States did have this from 1913 to 1968. That's when the 20% ratio was repealed. It can be lost very easily, and once it's lost, it's impossible to regain. Economists, central bankers, etc., they'll tell you, well, gold can't be money. The first argument you hear is there's not enough gold to support finance and commerce. So if you take the 24 trillion of money supply and you want to back it with 40% gold, you need $9.6 trillion worth of gold to support that money supply.